So we have half an hour to discuss financial technology and wealth management and other issues. By coincidence, precisely half the time I spent in the immigration line at JFK because the technology didn't work. So let's hope the great minds assembled here can work on the US infrastructure as well as on the financial services industry. On my immediate left is Renaud Laplanche, who's the Chief Executive and founder of LendingClub. On his left is Adam Nash, Chief Executive of Wealthfront. And on the far left is Rob Goldstein, who's the Chief Operating Officer of BlackRock and the head of BlackRock Solutions, the very clever people that go and analyze portfolios. So let's start off with a very general question, looking at how financial technology and big data have affected your business. Obviously, a lot in the case of you, Renaud.
No, certainly. I mean, so LendingClub is a credit marketplace. So we help consumers and small businesses obtain credit from sort of investors who come on the other side of the marketplace and provide the capital. And as you can imagine, we collect a vast amount of data on both sides. I think where sort of big data and the sort of abundance of computing power and storage space has been the most useful is actually in detecting fraud. I think we have an advantage over the banks is that we don't have a branch network, we operate at a low cost, but we are at a disadvantage compared to the banks in the sense that we don't see the customer and we can't ask for a driver's license, just like right there at the counter. So we need to use tools and data to combat fraud. And so we record every sort of interaction between the user and the machine. And we can get into some pretty granular and interesting ways to combat fraud. One of them being sort of just looking at the IP address of the machine, of the computer interacting with us, and sort of piercing through any sort of proxy server and going to the actual machine. We found some really interesting, with big data by running a lot of analytics, we found some really interesting correlations between the fraud rate and the time of the day where the application comes in, or the
so what's the worst time? What's the fraudulent time of the day? After the bars close, or?
Actually, anything outside of business hours is typically bad. We saw a lot of correlation between the type of browser being used and the fraud rate. I'm not going to tell you which one, even email address. And the most interesting is the time spent on the pages. With sort of fraudsters typically being sort of very fast and very good at filling in applications, or using algorithms to file automated applications and spending a lot less time on the page than an actual person. So a lot of.
So if you're slightly technologically inept and take a long time to fill in the form, you're less likely to be a fraudster.
That's right.
So Adam, how does it all affect you?
Yeah, so Wealthfront's the leader in a relatively new space called automated investment services. People come to Wealthfront, give information about their own personal financial situation, how they feel about risk, and Wealthfront not only gives them a portfolio, but actually actively will manage it for them, watching the investments 24/7, doing small things that we're all supposed to be doing, like dividend reinvestment and rebalancing, as well as sophisticated strategies like tax loss harvesting, all for an incredibly low price. From our point of view, this is the beginning, the cusp of a third wave of innovation to really help the individual investor. The first wave, I think, kicked off decades ago with incredible innovation in financial products, culminating with what we have today, which is the ability to own an asset class like the entire US equity market for just a few basis points. The second wave kicked off with the internet, where information that used to not be available to the retail investor is now available abundantly and for free. Information about securities, different asset classes, can all be had with a few keystrokes in your browser. This third wave that we think is kicking off now, we think will dominate for the next 10 to 20 years, is a wave of automation, of people actually trusting computers not just as tools, but actually as delegates, folks who will watch out for their own interests, make decisions on behalf of them. And we see Wealthfront at the forefront of this trend of a whole new generation of investors. Most of our clients are under 35, actually trusting an automated service to make decisions about their money to hit their long-term goals.
Rob, you're sort of in a different position. These two are the interlopers, as it were, and you're the established brand. We had a panel of bankers on earlier. Not to worry, they said bankers will triumph over the startups and incorporate their business. You feel as confident as the bankers on our first panel?
Well, it's interesting because having started at BlackRock in 1994 when we had 80 people, it's interesting because we're actually less than 30 years old. So even though today we sit here as the established brand, the mindset that we have is the same as it was going back to when I started, which is one of, at its core, the asset management business is an information processing business. And being in an information processing business requires that you not only respect technology, but that you push and lead innovation in ways beyond what we would like to think an old established player would do. So if you think about the rise of the machine as the title of this session, to a large degree, we have technology from the very beginning impacting every part of the firm, whether it be how we interact with clients, whether it be how we manage investments, whether it be how we manage the actual information that we process internally within the firm. And obviously, we've been able to leverage those capabilities through our BlackRock Solutions business to actually help other asset owners and other players in the marketplace be even better about how they service their clients. So as we look at technology as the established player, we don't view it any differently as the established player than we would if we were a brand new firm, with the difference that the scale that we could bring, the resources that we could bring, the data that we have access to is clearly unparalleled currently in the industry.
And how much of this whole process can be automated? Adam, you're going to say quite a lot, I'm sure, but can computers completely replace humans as sort of A, an interface with the customer, and B, in terms of judgment? Because one worry is that everybody has the same data, the computers will run the data and all come up with the same solution, so everybody ends up pointing the same way in the portfolio. I don't know how much that applies to you, but everybody else is looking at the credit, all your competitors are looking at the same sort of FICO scores and things like that to judge. And how much do you need to put some personal judgment into assessing who's a good credit risk and not?
Yeah, so I think there's probably no such thing as a good credit risk. There's a credit risk that matches sort of investor appetite or an appetite for risk. And so I think what technology helps us do is make losses as predictable as possible. And so you might target a 3% loss rate or 2% loss rate. And in that sense, consistency is a good thing. And taking out the judgment out of the underwriting is a good thing because you want to serve all customers who have the same credit in the same way. Actually, there are a lot of debate in the banking industry about fair lending. That's one of the areas where the CFPB, the Consumer Financial Protection Bureau, has decided to put a lot of effort, and rightfully so. And I actually believe that automation and reliance of data is a way to deliver more fair lending because we don't know what our customers look like. We have no way to discriminate against them even if we wanted to. So in that sense, making the underwriting purely model-based is a good thing.
Would there not be discrimination by location? Would your model make no difference by location?
No, that would be illegal. So there's a sort of input into the model is all applicable regulations, including sort of redlining, which is discriminating by zip code.
And what about gaming your model? So if you know from the outside that if you have, FICO score of 699 as opposed to 701 or whatever it happens to be, you'll probably be counted in this category of risk. So therefore you will you will alter your behavior or your inputs to try and get in that category.
Yeah, and so that would have been possible in the early days. We have 8 years now of data and history, and so every 6 months we build a new underwriting model and validate it and measure it against previous models. So initially it was just a few discrete criteria, and so if you had more than 660 FICO, less than 20% debt to income ratio, more than 2 years of credit history, that type of things. Now it's truly a model, and nobody knows. Nobody's on the outside knows what's inside the model. So it's impossible to game.
And Adam, can computers know the right answer to things like asset allocation? I was thinking, in the 1950s, up to the 1950s, most investment managers had a lot of money in bonds. Those portfolios were then destroyed by inflation. In the late 1990s, most investment advisors had most money invested in equities. Then you had 2 bear markets in the next 10 years. They should have had more in bonds. So is there not the danger that you sort of look at all the past numbers and come up with a portfolio that perfectly suits the conditions of the past, but not necessarily the conditions of the future?
You know, our chief investment officer, Burt Malkiel, who's the famous Princeton economist, wrote the book A Random Walk Down Wall Street now more than 40 years ago. It's been through 12 editions. And I think for the most part, we've seen that over almost every respectable time period, different ranges, different starting points, different eras economically, different countries. The truth is that humans have not demonstrated a fantastic advantage on average of allocating assets over time, right? Because of the things that you talk about. They have strong opinions, bonds now, stocks now. It turns out the basic mathematics around diversification, we could quibble about the exact methodology at the end. But for the most part, one thing that is hard to debate is that a vast majority of professional managers underperform that index. And the retail investor is even worse off than the professional manager by hundreds of basis points. And so to me, what automation offers is the benefit of taking best practices, adding in, as Renaud points out, deep personalization, right? I think we have this cookie cutter mentality of automation that goes back to manufacturing in the 50s and 60s of some giant machine stamping out the same thing. And that's not what automation offers at all. Automation has no obvious limit to the amount of personal data that it can incorporate into making decisions for you that are personalized for your situation, for the exact money flows that you have, for the exact goals that you have. I come from a computer science background, but when I was going through school, there's an entire branch of computer science dedicated to what are considered hard problems to solve algorithmically. Creating a college plan for someone is not actually one of them. Right? I think that there's immense opportunity for computers and automation to offer incredibly detailed best practice-based advice and management to orders of magnitude more people who need it and haven't had access to it. Because let's face it, today the current system that we have, which is very driven on retail branches and human-based advice, reaches a very, very small fraction of the population. Most Americans don't have millions of dollars. And the drag from paying 1 to 1.5% in fees can outweigh almost all the other best practices combined.
That brings on to Rob, where you've got sort of a large part of your business that is very low on fees, the indexing business, and another part of your business is active management. And I wonder whether there's a fundamental conflict within BlackRock that one bit of your business is cannibalizing another bit, which is a problem people worry about and the way that automation works in the economy generally.
Well, it's interesting because even I feel like the way the question was asked, it assumes a one-size-fits-all. So like as Adam said, fundamentally, when you look, there's a whole marketplace today that is not really served by retail advisors. And computers obviously provide an incredible ability to service that marketplace. Because absent the scale of the computer, it's very hard to achieve a human scale that's cost effective to give those people the service that they need. As we look at building portfolios, we believe, and we observe that many of our clients believe, that quite often the answer isn't all index or all active or all alternatives or all stocks or all bonds. It's a mixture and creating a combination of different strategies that in aggregate create a portfolio effect. So as we look at what we're trying to accomplish within BlackRock, what we're trying to accomplish is very simple, which is to service our clients and to be the most respected asset manager in the world. And to do that, we believe we need to give them the breadth of capabilities so we could help them and they could help themselves in terms of constructing portfolios, which is going to be blending these different products together, blending these different strategies together, but also providing them with choice. So for example, it's one thing to have indexation with regard to US equity markets. It's another thing, for example, to have indexation potentially in bonds if you believe that rates may rise over time. And there would be an opportunity where active management could add significant value if someone wants to have a bond allocation. So depending on the time, depending upon what the individual or the institution is trying to accomplish, how they build their portfolio will change and often mix the strategies.
But let me pick you up on that. When you say you believe, does that mean BlackRock believes that interest rates will rise over time, or the underlying client? Because a lot of underlying clients will have no idea. How can they be expected to know? So well, you'll be telling them the right solution, right? The computer can't tell you the right solution there.
It depends. You have to remember that when you look at a firm like BlackRock, for example, roughly 2/3 of our assets are from institutional clients. Most of those clients have a strong opinion about how to construct their portfolios, and they hire a variety of asset managers to help them do that. So they would have their own opinion. In addition, we have a variety of tools. In fact, we are fortunate. We just bought a digital advice platform called Future Advisor that would help an individual basically construct a portfolio based upon what they're trying to accomplish. And in that perspective, we would create a portfolio that is effectively a glide path to what their objective is. And I think that one of the key changes going on right now in the broader financial services and asset management industry is that customers, clients, individuals, if anything, want to have more of a conversation, whether it be through a computer or with a human. They want to have more of a conversation that's less about financial jargon and more about, this is what I hope to accomplish. I want to send my kids to college. How do I build a portfolio to do that? As opposed to, I want to have 8% in large cap US equities, 11% in something else, and so on and so forth. People want to talk about what is the outcome and objective they're looking for, and then leverage professional advice to build that.
Well, it's a very nice segue into the other issue, which is how this divides demographically. My father-in-law from New Jersey, he has Bob. He likes to talk to Bob, and he won't do anything unless Bob says it's a good idea. But you've got a divide between people who would like a hand-holding representative, who's somebody they know and trust, and then you've got younger people who may be more willing to accept technology. Presumably this works in LendingClub customers too.
That's right. Yeah, and LendingClub has a very mainstream appeal, right? So we're catering to a number of different demographics, and what we've seen is certainly some demographics being more familiar with the technology we use, and we want to use data and technology to reduce cost and increase convenience. Any demographics can benefit from these two, but the way they interact with the machine and the amount of explanation they need, and even the process we take them through, has to be different. I think for example, when we do income verification before granting a loan, we ask the person, the applicant, to give us the authorization to verify income with the employer. And one way we do that is a sort of automated API call to a payroll processing service that has the data from the employer and can give us that answer within a second or two. And so if we were to make that API call, give the answer to the client, say, okay, we verified your income, that can be really scary for people who are not used to that type of interaction, that type of speed, and that type of service. So sometimes we even slow down our response to the client, just not to spook them out with data. And
don't tell them what they're wearing as well. And how does that work with the Subgig economy? So younger people who are borrowers may not have an employer. They may, work to produce art for Etsy or whatever, or drive an Uber car. Do they come out worse on your models? I'm trying to find discrimination again.
No, so we cater to sort of employees, so W2 type of populations, as well as self-employed and small business owners. In that case, we'll have a different process, and so we're actually part of a sort of initiative with the IRS. With Internal Revenue Service to gain access to the 45060, which is a copy of the tax returns electronically with the consent of the borrower again.
And Adam, is there an issue for you that the younger people are more confident with the technology, but it's older people who have most of the money?
Actually, that's where we see the opportunity. So not surprisingly, at Wealthfront, we see this trend towards automation as very much demographically driven. I don't need to remind most of you, but this is actually the first time in decades that we've had not one, but two very large generations moving their way through the US economy. The millennial generation has more people to it, but is obviously younger, and I think controls something like 1/15 the amount of liquid net worth, right? 1 trillion to about 15 trillion. And so actually, I think the industry is very conflicted right now, because there's no question that if you have $2 trillion and you're looking for the third trillion, you're not going to get it out of millennials in the next 5 to 7 years. You have to go after the baby boom market, which, by the way, has very different preferences than the millennial market. So over 60% of our clients at Wealthfront are under 35, 90% under 50. And what we see is a generation of Americans that have grown up with technology. Money's a trust business, and we find that young people trust technology in a different way than maybe your father-in-law has for Bob. We also see a secular trend towards a skepticism or a cynicism about this idea that you can beat the market. We see it very definitively in demographics. Baby boomers are more likely to think that there's some way to either beat the market or be protected in a downturn. Gen X less so, Gen Y even less so, which is not surprising, given that in their young lives they've already been through not one but two phenomenal financial corrections, right? At the beginning of the century and then in 2008. And let's not forget that the financial crisis isn't that far behind us. This may be one of the few moments in time where having a 100-year financial brand is not an advantage with young people. I mean, I think the Viacom research showed that of the 10 least liked brands in the US, 4 belong to the largest banks in the country. Over 74% of people in their 20s and 30s indicate that they'd rather see financial services built from companies like Apple and Google and Facebook and LinkedIn. And not surprisingly, at Wealthfront, we've hired a lot of people from Apple and Google and Facebook and LinkedIn and asked the question, can we reimagine how this service is offered for this new generation? But the heart of it is conflict, because the truth is that that older generation does want different things from wealth management, from investment advice, than this younger generation. And we see that's the opportunity for innovation, because we don't need to generate $1 trillion in assets in the next few years. For us, billions of dollars is still big. I'm sure someday our eyes will get bigger. But we're excited about being able to make this technological bet on this new generation and grow up with them.
And Rob, you were saying a lot of your clients are institutional, but on the retail side, this must have an impact.
Yeah, and important to note, within BlackRock, we really interface through our retail business through distribution partners. So typically, large banks are our clients, and then they're going out to the end customer. But what we've observed is actually, I think there's a little bit of a confusion, and you touched upon this a little bit, between what is someone's preference and what is their requirement. So I think from a preference perspective, we've actually observed, and through a variety of surveys and other things that we've done, we've actually observed that everyone likes technology. It may be to differing degrees, but at this point, even if you have a traditional brokerage account and you're 65 years old, you have an expectation of logging in and seeing your statement. So a lot has changed with regard to how people interact with technology, and we view people really at a much broader age range being comfortable with technology. I think from a requirement perspective, there's just different requirements that people have. So Bob, in your example, may be very helpful as someone talks through how they ultimately are going to do estate planning, how they're ultimately going to think about how to structure accounts to leave to different people within their family. So I think that people forget that there's a big world out there. You had said it in terms of billions. The digital advice platforms today are starting at a very low starting point relative to all the wealth in the world. And there is a lot of segmentation, including people who historically have been underserved. But at the end of the day, the role that the financial advisor plays for a certain segment of people with a certain segment of requirements will continue to be invaluable in our opinion for a very long period of time.
Great. I want to throw it open for questions. If you can just hang on for the microphone before you see. Can I see anybody? No questions at the moment? In which case, I'm going to ask a quick one of you first. Quick answer while they think of a question. In 5-10 years' time, how different will the industry look from it looks today? I suppose particularly the lending industry. Were those banks completely wrong and LendingClub will be as big as Citigroup in 5-10 years' time?
Yeah, so we don't see it as a either or. I think the banks have a role to play. We have a role to play. And we actually have a lot of partnerships with the banks and we design these partnerships in a way that maximize value for consumers and businesses. And we play to each other's strength. So if you look at the cost of credit as the addition of the cost of operations and the cost of capital, LendingClub has the lowest possible cost of operations. We have no branches, we use automation and data to make decisions, and we deliver a great experience. But the banks have a very low cost of capital. They can collect very cheap deposits, they can borrow money from the Fed at a very, very low rate. And so the addition of these two, with banks becoming marketplace participants and essentially investing their deposits on our platform, has enabled us to lower the cost of credit for consumers and businesses. So I think there's more collaboration to be had.
And Adam?
Yeah, I get asked this question a lot in terms of what it looks like in the next 10 years. And I've been on the record as saying I think there are so many advantages to automation when it comes to managing a long-term portfolio that in 10 years, everyone will be using some form of automated investment service. But I think that question belies the fact that financial services just hasn't seen rapid innovation like this before, this type of disruption. I mean, 10 years ago, Netflix didn't do video streaming. They launched that in 2007. 20 years ago, Amazon was just selling books. So I think that what's most exciting to me is not just the innovation that we've seen in the last few years, it's the pace of innovation, right? The fact that every few months, yet another service, yet another type of benefit that previously only went to the wealthy gets automated and can be broadly distributed. If that continues for the next few years, then 10 years from now, I think we're going to be incredibly surprised at how much of an individual's financial lives are managed by an automated service.
The last panel mentioned, just to come back on you, that the problem for companies like you is the cost of acquiring customers. So it's not quite the same as everybody starting to use the Uber app or whatever. You've got to go out and find people. Is that a...
Actually, this may seem obvious from someone whose previous job was building out core product at LinkedIn, but most of our customer acquisition is free. I mean, the number one reason that someone joins Wealthfront is because they were referred by another client who already uses Wealthfront and loves the service. Our viral system is not that unlike Dropbox. People get $10,000 managed for free. If they invite someone else, they get another $5,000 managed for free. It may not be as sexy as getting 0.5 gigabyte of cloud storage, but it seems to work fairly well. And so I do think that a lot of the growth that you're seeing right now in innovation is the product of us taking all these lessons from Web 1.0 and Web 2.0 and social networking and moving them over to an industry that just hasn't seen that level of innovation before, at least in the customer experience.
I'll talk to my father-in-law afterwards. Rob, you worried about these guys eating your lunch 10 years' time?
Well, I view them as partners and clients. So the reality is you guys are a client of ours. The reality is there's a lot of opportunity. You need capital. We have capital, right? That's fundamentally how the model works. So if anything, I think the ecosystem is evolving such that we're all going to get closer together, and it provides opportunity for all of us. Just leveraging the last few seconds, I'll mix it up a little bit and say I think all of us, as we spoke a lot about things from a customer perspective, but I think also equally as important over the next 5-10 years is we should recognize that no matter what statistic you believe in, it's something like 90% of the data in the world was created in the last 2 years. So even if that's not perfect, it's directionally accurate. And that data set and what it does and the opportunities that it opens with regard to how one actually manages money and how one generates alpha and how one builds portfolios is an enormous source of innovation that we'll see over the next decade. And that's something that we're quite excited about. We have this term within BlackRock, big data, big alpha. And we believe there are significant opportunities there, and that will also be an axis that changes quite dramatically over the next decade.
Thank you very much. Well, ladies and gentlemen, I apologize you didn't get your video. I'm sure it's going to be available on Netflix soon. But you got more of the panel as a consequence, and I think that was a bargain. So can you thank them very much indeed, and can you...